Hi, everyone. Thank you so much for joining us today for the Boutique Hotels Guide on the topic of insurance during this crisis. I'm Frances Karagian, CEO of BLLA, the Boutique Lifestyle Leaders Association. All of us at the association warmly welcome you.
We are very happy to have partnered with Lockton Companies today to provide resources for boutique hotels specifically. You have a voice as an independent hotel in the world, and we are all going through a crisis together. So BLLA is coming up with different resources to help you recover. And we are so grateful for our partnership with Lockton Companies today to provide you some very, very valuable tools on insurance during this crisis. Please know that we are in this together. We are a community and we are resilient. And with that, Richard, I'll give you the floor.
Thank you. Thank you very much, Ariella and Fran. Good morning to everybody. I'm Richard Roderick, partner at Lockton Companies. Our firm is a global leader in commercial insurance, providing risk consulting, brokerage, and employee benefit services with a very significant client concentration in hospitality, including boutique hotel operators and the full spectrum of restaurant and other clients. We're the largest privately held, independently controlled firm at the top of our industry, and we too place a great emphasis on our independence, which allows us the flexibility to best respond to our client needs. This is an unprecedented time characterized by massive global volatility, unforeseen economic pullback, and abrupt disruption of cash flows for our clients. Our hospitality clients in particular are grappling with unimaginable conditions with literally no blueprint from which to operate. Lockton is in the boat with them and completely aligned with our clients in this sector. As our clients go, so goes our own business. So we are undoubtedly headed for a rough period alongside of them. To recap the unthinkable past 14 days, our panelists will speak to and provide additional perspective on the travel bans, quarantine, civil authority, business interruption, and ensuing economic loss. Yesterday, national unemployment claims spiked to a record 3.28 million, 3 million higher than the previous month, and nearly 5 times greater than the next highest figure for any period in history. Some analysts expect the unemployment number to potentially hit 5 to 7 million. Particularly hard hit and significant contributor to the employment disruption has been the hotel, restaurant, and travel sector, with analysts projecting a $225 billion sector loss. Electronic payment transaction volume for the hospitality sector has decreased by 91% in California, making it the most severely impacted state, with New York City running at 16.8% occupancy and San Francisco reporting even worse conditions. The US hotel sector as a whole is running at about 30% occupancy. Goldman Sachs marked down its forecast and projects 2020 GDP to finish at minus 3.8%, but optimistically projects a rapid rebound to the overall economy in quarters 3 and 4, while expecting unemployment to peak at 10%. Consulting firm McKinsey is a little less bullish and views the demand shock at 5 to 6 times worse than what hit us on September 11th. Because of the travel bans and disruption of the summer travel season, the sector is imperiled. However, domestic hospitality is expected to lead the sector with a faster recovery expected in 2 to 3 quarters. Then there's the unprecedented and enormous $2 trillion government stimulus package, which passed the Senate and is expected to pass the House today, with the president signing into law to speed relief to disrupted employees and businesses. To discuss all of this and the commercial insurance and employment-oriented implications, on the call with us today is Scott Behrens, Lockton's Director of Governmental Relations, who will provide a Capitol Hill update. Ed Finchholt, Lockton's Director of Compliance, will speak to employer obligations associated with the massive layoffs and the conditions in the economy. Brian Murphy, a partner and hospitality expert from the law firm Shepherd Mullen Hampton Richter, is covering the legal issues and employment law that will frame many of these events. And last, but certainly not least, Paul Primavera, Lockton's global claims practice leader, tackles the serious matter of business interruption claims and how we will and are advising our clients on to handle these. Scott, now that I've re-ripped the Band-Aid off, tell us what's happening in Washington, D.C. right now and what this means for our employers.
Thanks, Richard. Thank you all for allowing us to join you today. Certainly, Congress has been active in working on legislation to address the epidemic, and they've done so in a number of ways. Early in March, we received our first coronavirus-related bill, which increased small business loan funding for businesses with fewer than 500 employees. There's still loans available through that program up to $2 million. There's certainly a lot of information about those loans on the Small Business Administration's website. About a week and a half ago, we received the second coronavirus-related bill, the Families First Act, and this did a number of things. One of the most important things that folks have talked about it doing is for private employers with fewer than 500 employees, it requires those employers to provide paid leave to their employees. There's two different paid leave programs, the first one being paid sick leave, and then the second one being an expansion of the FMLA for paid family leave. The paid sick leave is 2 weeks of paid leave that can be taken for the employee's own need for isolation, whether government mandated or for their own health reasons, as well as to seek medical care. Can be taken for the employee caring for another individual, or the employee caring for a child, or a child whose daycare or school has closed because of the coronavirus. The leave that needs to be paid is $510 for the employee's own isolation or medical care, and up to $200 for the care of another individual. That leave can be extended under the expanded FMLA rules for employees who are caring for a child because of the school closure or daycare center closure. And under those rules, that leave payment can be up to $200 per day for up to 10 weeks. Understanding that employers would certainly have some challenges around the cash flow of providing that leave, Congress did include in their tax credits that are equal to the amount of leave paid under those programs. The tax credits do not extend to leave paid under voluntary programs or state mandated programs, just for these two new paid leave requirements. And the credits are equal to the leave paid. Essentially what employers are able to do to ensure liquidity is they are able to reduce the amount of payroll taxes they would otherwise remit to the federal government by the amount of the credit. So essentially it's an advance credit where you're able to keep that cash and use it for other purposes. If the amount of the credit is larger than what your payroll taxes are, that credit is refundable, so the federal government will provide that back to you at some point after you file those payroll taxes. These leave requirements begin on April 1st. So if you have employees on April 1st who need to take these leaves, that's the group who it applies to, not to anybody who has already been terminated. So Congress quickly recognized that that package was not going to be sufficient. And so, as Richard brought up, we are now talking about this enormous $2 trillion package. As he mentioned, it passed the Senate the other day. The House is, as of right now, debating that legislation. They've got about 45 minutes of debate left, so there's a chance that by the time we're done with, we're toward the end of this webinar, they will have passed it as well. So obviously $2 trillion, there's a lot of things in there. I'm going to focus on some of the business stabilization aspects of it and the individual stabilization aspects of it. So the focus here is to ensure liquidity for businesses, or at least get them some additional cash, and to ensure that employees retain employment throughout this crisis. So one of the major building blocks of this is enhanced loans through the Small Business Administration, in addition to the loans that we talked about. The loans are available from or through June 30th. So generally, employers with fewer than 500 employees are eligible for these loans, and it includes the self-employed, independent contractors, and sole proprietors. The loans are fully backed by the federal government, so you're not having to put up any collateral to get the loan. The loan proceeds can be used really for paying operational expenses, anything from payroll, rent, health insurance, other insurance premiums, and utilities. In this piece for these businesses under this loan, that loan can actually be forgiven, provided that the employer continue to employ or rehires employees who were previously terminated throughout the period of the loan. So if you retain employees, at least a portion of the loan could end up being forgivable. There's also another expansion of the SBA loans. There's a disaster loan provision, which can also be applied for if the loan above does not apply, and that includes a $10,000 advance in that loan application before the application is even approved, and that $10,000 does not need to be repaid. The Small Business Administration is working on updating their website to provide the details of how to apply for that. It's not entirely clear at this point how businesses apply for those loans, and it's not entirely clear how the money gets dispersed. We've been hearing discussions that these are going to be first come, first serve. So if you're interested in those loans, you'll definitely want to be keeping an eye on that and working with your financial advisors to make sure that you go through the application process correctly. In addition, to provide some additional liquidity, employers are able to take an employee retention tax credit. So this is in addition to the small business loan. So you don't need to have the small business loan to do this. And essentially what it says is that you can take a tax credit of 50% of the first $10,000 of wages and the cost of providing health insurance benefits through the rest of 2020 for retaining high enough level of employees, provided that the business was substantially affected by the coronavirus, which I think, as Richard pointed out, the hospitality sector is very much affected by that. So in short, you'll be able to keep some of those payroll taxes that you would otherwise have to pay. And then on the other side, the government is allowing you to wait to pay the remaining payroll taxes for a period of 2 years. So your payroll taxes that you would pay normally for the remainder of 2020, you can defer the payment of those amounts to the federal government, half of which will end up being due at the end of 2021. The other half will be due at the end of 2022. There's also quite a bit in the stimulus bill directly impacting individuals. You've probably heard about the checks that are going to be sent out, $1,200 per adult, $500 per child. Those amounts are phased out at $75,000 for individuals and $150,000 for joint filers, reduced, I think, for the next about $25,000 to $50,000. One question that's come up on those checks are not taxable, and they will not offset refunds in future years. Also, certainly understand that a lot of employers are going to need to do layoffs. And so there's a substantial increase in aid through unemployment benefits. Key thing to remember when it comes to unemployment is unemployment insurance, unemployment compensation is largely run through the states. States are incentivized by this new legislation to expand the number of weeks of unemployment that are available, to rely on the federal government for more cash to increase the amount of supplemental wages that are paid, and to increase worker unemployment compensation checks by $600 for the next 4 months. But it's up to the states to implement those. Each state is different, so you'll definitely want to pay attention to what's going on in your state. There's also a provision in here that encourages the states to adopt a procedure for the states that haven't already, that would allow unemployment benefits to be paid to individuals whose hours are reduced. So they might still be working, but reduced hours, and then the unemployment compensation would be able to supplement some of that. In addition, there are some retirement provisions allowing for additional distributions without the typical 20% withholding requirement and 10% withdrawal, early withdrawal penalties. And it allows those distributions to be repaid without penalty over the course of 3 years, and allows the income taxes to be spread out over 3 years. So if you have a retirement program, there's some opportunities to amend your plan to allow individuals to get some additional compensation out of the retirement plan to help them through this challenging time. Also, several health and welfare benefit provisions, which I will let my colleague and friend Ed Finchel talk about here in just a minute. Final word, we do expect there to be another package that will come through Congress. Right now, we're hearing most likely sometime late April. There is disagreement about that package, whether there will be one, so we'll certainly have to wait and see. I know Paul is going to highlight some of the business interruption issues. There's some concerns around that we are looking at trying to address in that future legislation, as well as some additional expansion to stimulate the economy and address any of the shortcomings of the current $2 trillion package. So with that, I'll turn it over to Ed.
Well, thank you, Scott. Great work. Well, I'll tell you what, what Richard said at the outset, this is really unprecedented times, and it almost feels like we're on a wartime footing. And I know Scott's been trolling the halls of Congress in person, and then lately, Scott, just virtually, because they won't let you up there anymore due to the virus, but or any visitors up there anymore. But great work there. For those of you listening, Scott was pretty instrumental in getting some of these employee benefit provisions pushed through in this bill. So we're really grateful for him. Next slide, please. I might say here, Chairman Roderick, I'm going to yield back a little bit of my time to our colleagues Brian and Paul at the end. I think the leave issues, the business interruption questions are going to be much more on the front of mind for our listeners. But I'm gonna hit through some critical benefits-related items. These are you might even call them in this context nuisance issues, but they can certainly come back to bite you if we're not at least aware of what's going on here. A lot of you are subject to the employer mandates. I'm sorry, the employer mandate under the Affordable Care Act. Some of you may be too small, but I think most of you are probably subject to that rule. Most of you then you will tie eligibility, you are hardwiring eligibility to Affordable Care Act full-time status. So that employee is averaging 30 hours a week over an extended measurement period. They're eligible. If they're not, then they're not eligible. For the employees who are, these ACA full-time employees, the thing about a furlough of these employees is if they earned ACA full-time status over last year's measurement period, this is like a frequent flyer program for an airline, you have to treat them as an ACA full-time employee for the entire current plan year, unless they're terminated, unless they're laid off. They merely furlough these employees, retain that ACA full-time employee status. If your medical plan is hardwiring eligibility to ACA full-time status, those folks remain eligible, even on furlough. That may be a good thing. That may be what you want. It becomes a bad thing if you reach a point due to cash flow where you can no longer sustain a plan. You have to suspend coverage under your plan or terminate your plan. Now, because you furloughed these employees and not laid them off, not terminated their employment, you've got a bunch of ACA full-timers on your rolls for whom a coverage offer is not being provided. That triggers what we call the nuclear penalty under the Affordable Care Act, and you don't want to do that. So there are consequences to the decision between furloughing an employee. By furloughing, I mean an involuntary leave of absence, as opposed to a layoff, or I mean you're actually terminating employment. When they come back, you're going to rehire them. If you have an eligibility rule in your medical plan and it's not delivering for you the result that you want, you either want to take care of your employees and continue coverage for a while they're on furlough, or you're worried about what happens next year. These employees aren't working now for a great part of 2020. What happens next year when you're averaging hours in 2020? What happens to their eligibility next year? You can amend the plan later to deal with that, and we're happy to talk you through any of that. The right side of this page, though, is important, and this is critical because when cash flow becomes a problem, employers have difficulty paying premium on their medical plans, and a great number of states now that their departments of insurance are weighing in, and most of them are simply encouraging health insurers to be flexible, to work with their group contract holder clients and either give them a grace period for paying premium, or work out some other accommodation with them. The state does not want these insurance companies canceling group coverage for non-payment of premium, at least not for a while. They're really kind of turning these insurance companies into banks, if you think about it like that. A couple of states, Georgia and Alaska most recently, have said you can't cancel coverage. California, I think at this point, is simply encouraging carriers to work with their group contract holders. Here's a critical point, though. Most of you, if you maintained a group healthcare plan, you had your employees who were enrolled in that plan paying premium, which is at least some of the premium. You were deducting that premium from payroll on a pre-tax basis, quite likely. If you've done that, if you have deducted money to pay premium from an employee's paycheck, and that money is sitting in your general asset account, and you've not forwarded that to the insurance carrier because you don't have the cash flow to add your piece of that premium payment to it, don't forget that employee money belongs to the medical plan. It is extremely protected by federal law. You cannot use that money to pay the light bill. You cannot use it to pay wages or to pay a creditor. People have gone to jail for that kind of thing. So if you've got employee money sitting in your general asset account for premium that has not been forwarded to the carrier, I would either forward it to the carrier as a partial payment and say, look, we're going to try to get the rest of to you as soon as we can, or I would refund that to my employees, because if worse comes to worse, and God, I hope to God it does not, but if insolvency ensues at the corporate level and that money is gone. There will be hell to pay later with regard to that employee money. Next slide. I'm going to skip this slide. Read this at your leisure. This is about subsidizing COBRA coverage for the employees who are furloughed and lose eligibility, or laid off and lose eligibility under medical plan. You got to offer them COBRA. Some employers are subsidizing that COBRA premium. Next slide. A lot of questions about this. A lot of you maintain what we call these cafeteria plans, these tax code section 125 cafeteria plans. It allows the employees to pay for their benefits on a pre-tax basis, and you avoid payroll taxes on those dollars. So these are really nice little fringe benefit plan funding vehicles. When an employee elects into coverage under a cafeteria plan at open enrollment or initial enrollment, they're locked into that election. They can't change that willy-nilly just because they want to, because of financial hardship. None of that. There has to be a discrete qualifying event to allow them to change those elections. Now, if they're being terminated, of course, it's a moot point. But if they're merely being furloughed and they haven't lost eligibility for coverage, it's really difficult under the rules to allow them out of those coverages, even due to financial hardship. Here's the overarching point I want to make about this. These are unprecedented times. It's anathema to me as an advisor to you, as an attorney, to tell you to consider flaunting the rules. But I will tell you, and I can't tell you the rules don't exist. I can tell you they're not there. But I can tell you that if you want to cut your employees a break here and let them out of some of these things, the risk to you is about de minimis. The IRS paid no attention to these rules in the best of times. They're not going to do it here in the worst of times. You do what you think you need to do to help your employees. And I think as a practical matter, nothing's going to come from that. Next slide. Scott alluded to some of the welfare benefit provisions, both under COVID-2, that is the second bill the Congress passed, and COVID-3, the stimulus bill. Just a real high level summary here. If you're maintaining a high deductible health plan, an HSA compatible plan, you're allowed to pay for COVID testing and treatment below the high deductible. That is, before the employee is satisfied the high deductible, and you're not going to blow up your HSA compatible plan. In fact, under federal law now, your plan has to cover at least the COVID diagnostic testing, and it's got to do it now under COVID-3, even if that testing is not FDA approved. So the feds are pulling out all of the stops here. When a vaccine becomes available, your plan's going to have to cover that vaccine at no cost sharing as well. COVID-3 reversed a little rule that was put in a decade ago in the Affordable Care Act that made it impossible to have a flexible spending account or a health reimbursement arrangement, reimburse over-the-counter medicine tax-free. These are now tax-free again, a decade later. Telemedicine, the feds are encouraging telehealth and telemedicine. They don't want your employees rolling into a doctor's office in person for fear of spreading the virus. One of the challenges with telehealth was for an HSA compatible plan, carriers, vendors, telehealth vendors were waiving all cost sharing, having the employer pay that below any kind of high deductible. And in theory, that was going to blow up a high deductible plan. This is one of the things that Scott pushed for and got in the COVID-3 bill, a complete free pass for telehealth services. The employer can pay for this below the high deductible, and it does not jeopardize any kind of HSA qualified scheme. If you're considering throwing, and we've had clients do this, they threw in a telehealth portal now for their employees, and they expanded eligibility to those who were not even eligible for the major med plan. So maybe part-timers or others, seasonal employees that weren't offered medical, but now you're putting in a telehealth plan for them just to cut them a break. You can file this under the no good deed goes unpunished category, because what you've done is put in a little ERISA plan for them, subject to all of those bells and whistles, annual reporting, preventive care requirements, most sinisterly though, the COBRA continuation coverage notice provisions. And I don't know, if you were going to put this in for 2 or 3 months, you'd almost certainly get away with just doing that and forgetting that it ever happened. But if you're going to do this, you want to think through whether we should also engage our COBRA vendor to provide COBRA notices on this little telehealth plan, because employees do sue you over COBRA notice failures. It's the most litigated statute in the benefit scheme, and courts award monetary penalties for notice failures all the time. Next slide. I'm going to skip the left column. The right column is interesting. There's a section in the tax code, section 139, that allows you to make tax-free reimbursements to employees, not for wages, but for their expenses during a disaster like this, like an emergency like this, national emergency. So if you wanted to, you could provide tax-free reimbursements to employees for things like dependent care. There's almost no guidance on this, so almost anything would go. If you wanted to reimburse an employee for their Netflix subscription because they're home now and they need something to do, looks like you could probably do it under this thing. The employees don't even need to substantiate their expense. They can just tell you they've incurred the expense and what the amount was. You can cut them a check, tax-free reimbursement. Pretty remarkable little section there. Is that my last slide? Next slide? Is that it? That's it. All right. Well, Mr. Chairman, I yield back the majority of my time and the balance of my time to Brian Murphy.
Thank you, Ed. So Brian Murphy, I'm an employment lawyer representing employers exclusively. I'm based in New York, and over the last 2 to 3 weeks, I've had the misfortune of providing effectively round-the-clock advice to employers seeking to grapple with the ramifications of this pandemic on its workforce. There are an untold number of employment laws that are ultimately implicated in the crisis, but I'm going to sort of tick off the top areas in which I've received inquiries from clients. The presentation today is going to be high level out of necessity. We could present an hour-long webinar on each of these areas, but it is useful to comb through them just to give you an idea about the different areas that you should be aware of and the issues that might arise. So Scott started off talking about what I think is the most significant piece of legislation that thus far has passed, and that's the Families First Coronavirus Response Act. As Scott mentioned, it's effective April 1st. You can see the requirements there, 500 or fewer employees. There is some flexibility potentially for employers that are approaching the 500 mark that maybe own multiple properties to potentially join those properties together for purposes of getting out from underneath this law. It's a little bit of a complicated process, and it does have a few disadvantages. Long story short, though, there are two components to this law. The first half provides 12 weeks of job-protected, job-guaranteed leave. The first 2 weeks of that under the FMLA expansion are unpaid leave, whereas the last 10 weeks are paid at 2/3 the regular rate of pay with a cap of $200 per day or $10,000 total. Keep in mind, for that first 2 weeks of unpaid leave, an employee can choose, an employer may not require an employee to substitute other paid leave the employee might have available, such as sick leave under a state or city program, or PTO leave that they might have. There are a few exceptions. I noticed I stated one at the outset, which is combining properties to get above the threshold at which this would no longer be applicable. But a few others are deserving of attention given the likely size of your workforce and the circumstance presented. One, there's an exception for employers that have less than 50 employees where compliance with the law, notwithstanding the fact that down the road tax credits might be available, present day compliance with the law is not feasible, economically feasible, and could prove to disrupt or end the business. There's no real guidance yet on how to go about managing that exception. We do know that there's no formal application process in place. It's at this point just advised that employers with less than 50 employees that don't believe they can comply with the act just document the reasons why they don't believe they can comply with the act in case they're tested upon that later. A second principle is that for an employee to be exception is that for an employee to take advantage of this, they must be unable to work for the enumerated reason. And that is just limited to this, again, this FMLA expansion is limited to needing the time off to care for a child, a dependent, because of a school closure. So they have to be unable to work for that reason. Now, the unable to work phrase also carries with it the connotation that if someone is able to telecommute, if someone is able to work outside of their normal hours, they are not unable to work under the statute. That may be relevant for some, but not other hotel employees, but something to keep in mind. Last piece, which was actually clarified last night at about 11 p.m. by the Department of Labor, is what to do with furloughed employees, what to do with laid off employees. The Department of Labor set forth about 35 FAQs on its website and made clear that employees who are on an unpaid leave, an unpaid furlough, are not entitled to benefits under this act because there is no work for them to do. They're not unable to perform work to be done. Same goes for temporary employees. I'm sorry, for laid off employees. They are not eligible for benefits as of the guidance from the Department of Labor last night. And that's just one half of the FCRA. The other half is the paid sick leave component. Again, this applies to 500 employee or less employers. That small business exception that I mentioned before, can I get the next slide, please? That small business exception that I mentioned before is similar. Just document the reasons for which you believe you cannot comply with this requirement and put that in a file somewhere. This provides up to 80 hours of paid leave at the employee's regular rate of pay, capped at $510. There's an error in my slide. $510 for the first three reasons set forth there. So if the leave is taken for an order to quarantine, a recommendation to quarantine, or someone's experiencing symptoms and seeking a diagnosis, they can, depending on their wages, receive up to $511. The latter two conditions, caring for someone subject to quarantine and childcare because of school closure, the cap is reduced to $200. You'll note that one of the reasons for taking this leave, caring for a child because of school closure, is identical to that under the FMLA, the 12-week leave. So what this does is it allows an employee to take the paid benefits under this provision of the Act and apply them to the unpaid 2 weeks of leave that would be available under the FMLA portion of the Act. Again, you get dollar for dollar tax credits down the road. And again, these provisions are not applicable to employees that are able to work remotely or otherwise able to perform their job, even if outside of normal working hours or normal working circumstances. Next slide, please. So I do want to be clear. Those are the main features of the FFCRA. They, like I said, the Department of Labor issued guidance on them last night. The stimulus bill, when it is passed, does have some tweaks in it that may impact portions of the bill. We don't believe it's going to impact anything I just discussed, but there are certainly various permutations and issues that are going to arise under that law. Ordinarily, when we're giving a webinar or providing advice and counsel about a statute and its applicability, we typically have years of experience, years of court cases, years of regulatory guidance as to how that is all going to play out. Here, this is fresh, so we're going to be learning as we proceed. But the federal piece is not the only thing employers need to consider. Just to touch on New York and California briefly, there are state paid sick leave laws which are not diminished by the federal law. They're not disturbed. So these leave allotments are available to employees in addition to what's provided under the new federal laws. Again, you just always need to be precise when someone comes to you with the need for leave. What is the reason that they are seeking the leave for? And then you can determine what leave allotments might be available. So we covered the federal law. The New York State paid sick leave law implemented the same day as a federal program, applies to employers of 100 or more employees, but the reason is quite narrow. There has to be a mandatory or precautionary order of quarantine issued by the government or a local board of health. So an employee whose doctor recommends that they stay home or who themselves decides to self-quarantine is not eligible for the state paid sick leave. I'll note as well that the intersection with the state stay-at-home executive orders that have come out. So New York has one of them, California has one of them. Those have not been deemed to be orders of quarantine. So there's not a statewide trigger at this point that provides employees with the allotted New York State sick leave. California's requirements were in existence, at least the state requirements were in existence prior to this. So those benefits are still available for use for COVID-related absences. But then last but not least, you need always consider city and local sick laws. I won't get into too much detail, but both New York City and San Francisco, for example, have detailed sick leave laws, which are, again, in addition to any of the state benefits and in addition to any of the federal benefits. So there are scenarios, again, provided the appropriate reasons for the leave are being taken, where you could result in some sort of stacking mechanism such that employees are receiving a little bit more leave than you might have otherwise anticipated. Next slide, please. Those are the statutory frameworks. Keep in mind that you as employers, certainly in your employee handbooks or elsewhere, might have your own employer-generated policies, part-time, paid time off policies, and vacation policies. The use of those is going to be governed by your policies. We do have flexibility, certainly in New York, certainly in California, to restrict use of those policies. You can't require an employee to forfeit, but if operational needs require an employee to be at work, they don't qualify under any of the sick leaves, we can restrict their ability to use PTO or vacation leave. We can make changes to those policies prospectively, never retroactively. And in certain circumstances, we can require their use if, for example, we have employees just on leave and we want to require them to supplement their wages or otherwise make up for a lack of wages, we can require their use. With one exception, when you get into an employee on eligible for the federal or state or local city sick leave laws, we might not, certainly not under the federal, require an employee to use our PTO or vacation time. We can allow them to choose to elect, but we cannot impose that upon them. So I raise the employer policies just as for the point being, now's a good time to revisit some of those policies, determine if any prospective changes are necessary, and communicate with your workforce around how you might have an eye towards administering those policies during this crisis. Next slide, please. So wage and hour issues. This has come up most often in the context of how can we reduce costs. So employers are looking to rapidly reduce costs, oftentimes looking to avoid layoff scenarios. So what can we do with wages? What can we do with hours to reduce our overhead in the short term, possibly longer term, without running afoul of wage and hour laws? So generally speaking, reduction in wages, generally permissible as and non-exempt employees. Exempt, referring to exempt from overtime requirements, non-exempt, not exempt from overtime requirements. Non-exempt employees, the only two things you really have to worry about are whatever their wage is now, you can reduce it as much as you want, so long as you stay north of the applicable minimum wage. In New York City, for example, that's $15 an hour. Second requirement being, those changes must always be prospective. You have to provide an advance notice in both California and New York, and certainly various other jurisdictions. There are forms available through the Department of Labor, local Department of Labor, that comply with those requirements. Keep in mind with non-exempt, just with an eye towards cost savings, you only need to pay for hours worked. So if you have more generous policies where you're paying for whatever reason, all hours that someone's on site or something like that, it's just a responsibility to pay for hours worked. So too with exempt employees, we're entitled to reduce the salary of exempt employees, those exempt from overtime, keeping in mind two principles. If you want to keep the exemption such that they can work unlimited hours in any given work week without triggering an overtime responsibility, you just have to stay north of the applicable salary threshold. York City, that's $58,500. And again, you would have to provide advance notice. Exemption, maintaining the exemption also requires that it be paid on a salary basis. That means any employee who is exempt receives their full salary for any work week in which they perform any work whatsoever. So if they work, they're entitled to their full salary. So you're not necessarily achieving a savings unless you're reducing that salary, and beyond that, reducing that salary, the hours worked to zero. It can be, but need not be accompanied by a reduction in hours, because as I said at the outset of this portion, exempt employees, provided they're properly exempt, can work unlimited hours. A third option in this regard is a conversion from exempt to non-exempt. This might be a difficult pill to swallow for some employees because exemption sometimes carries an air of achievement with it, but it is fully permissible for an employer to say, I need to reduce payroll to such an extent that I can't even maintain the minimum salary threshold. So I'm going to change employees to an hourly rate. It could be, even if they were formerly exempt, it just needs to be north of the minimum wage, $15 in New York City, and you can then pay them on an hourly basis. Next slide, please. The flip side is reductions in hours. So we spoke about reduction in wages, reductions in hours for exempt and non-exempt employees. A non-exempt employee, you can reduce their hours to zero. You do not have to advance notice, aside from not wanting someone to show up to work, notifying them in that regard. But you reduce their hours to zero, or some other increment. You need to only pay for the hours that they actually work. For exempt, as I was saying before, reducing their hours doesn't carry all that much of a benefit, since you'd be fully responsible for their salary, whatever level you ultimately implement for any work week in which they perform any work whatsoever. You only really experience a benefit if you reduce their hours to zero for one or more work weeks. But in that case, again, you need to put some thought into some discipline around ensuring that no hours are worked, such as cutting off email, advising them of expectations, and advising them of potential discipline should they perform any work. Because if they do perform any work, whether it's authorized or not, you would be responsible for their entire salary for that work week. Next slide, please. So operational considerations. We touched upon this briefly. We had these stay-at-home orders that have popped up on throughout the states, certainly New York and California. These executive orders that are issued by the governors put restrictions on whether or not you're allowed to even have workers report to work. The reference point in each of these laws, albeit phrased a little bit differently, is whether the business qualifies as a quote-unquote essential business. So from what I've seen in New York, hotels and places of accommodation are presently considered essential businesses. So the executive order does not necessarily impact the New York hotels, but in California, it appears not. In California, there are 16 essential critical infrastructure areas, and outside of some small exceptions where hotels are being used for COVID-19 mitigation measures and containment, that we're largely restricted from having workers on premises. There are little exceptions to be aware of. There are permissibility for skeleton staff. At the end of the day, someone might need to be there to pick up the mail. Someone might need to be there to adjust the thermostat. But exercise those exceptions sparingly, because the fines for non-compliance can get pretty expensive. Next slide, please. Telecommuting, just a couple brief points on this. It's certainly not going to be applicable to all hotel staff. Where possible, where feasible, where it makes business sense, it is fully permissible. Just keep in mind that the wage and hour laws, well beyond those I've already touched on, but all wage and hour laws are ultimately just as applicable in the home as they are as if someone is on site. So practical tips, just what we don't want to get caught with is unexpected hours, overtime hours, record-keeping violations, etc. So give some thought to distributing your policies and communicating your expectations around what a telecommuting circumstance might look like before implementing it to mitigate against the possibility of an outsized payroll bill down the road. OSHA has a lot of requirements, but I'm just going to speak about two that might be relevant. So it does impose a duty of care on employers to furnish a place of employment which is free from recognized hazards that are causing or likely to cause death or serious physical harm. What that means at the present time is that at some point, if you don't have employees on site before returning to work, a deep cleaning, certainly lots of companies are popping up that specialize in this, but a deep cleaning from a reputable agency is recommended to stave off any claims for violations of this provision. Another issue that was popping up more earlier, but is still present to some degree, is employees refusing to report to work over concern that they're going to catch the coronavirus. The standard under OSHA, which would allow an employee to permissibly refuse to report to work, is there must be an imminent threat of physical or mental harm. A generalized concern about the communicability of the disease is insufficient. As we're interpreting it, there needs to be a little bit more of a specific circumstance. We know of other employees that are infected. We know of other patrons that were infected on the property. We have not yet conducted a cleaning. Something like that to allow an employee to not report to work under those circumstances. Should those circumstances not rise to that level, there is no basis for them to do so, and we're able to discipline them. Next slide, please. So I'm going to finish with some termination considerations. You've heard each of the presenters use these terms in one context or another. This just kind of summarizes the legal significance of what those terms actually mean. So you'll have this slide available to you. But generally speaking, furlough is an active employment circumstance just with reduced or no hours being worked. So they are effectively an employee for all intents and purposes, aside from, as the DOL guidance taught us last night at 11 p.m., the FFCRA does not apply to furloughed employees. Layoff is sort of a temporary pause in the employment relationship, but things like benefits do terminate, unemployment becomes available. There may be PTO, pay time off, payouts, and final check and severance considerations. And termination outright just is a slight variation on that, in that all the same sort of ramifications arise. However, there's really no expectation of recall. Next slide. So when we're in the termination or layoff posture, you do need to be aware of WARN Acts. WARN stands for the Worker Adjustment Retraining Notification Act. And just generally speaking, there is one federal one that applies across the country. And then there are a number of states that have what we call mini WARNs, New York and California included. The idea being behind these laws, they exist to provide workers with advance notice of a business closure or layoff. The notice is usually 60 or 90 days advance and typically requires pay for each day to each affected employee, by which we're underneath the requisite notice period. I'm not going to go through all of the different permutations of the WARN Acts, but two escape valves to effectively be aware of. One, under all of the laws, there's a requisite number of employees that must be affected by the layoffs before the WARN obligation is triggered. The lowest number that I'm aware of is in New York, and it's 25 employees if those 25 employees make up at least 1/3 of your workforce. So if you have 50 employees and you lay off at least 25 employees, yes, that's 50% of your workforce, notice would be required. If you have 100 employees, but the layoff is only affecting 25 employees, you're beneath the threshold, so no notice would be required. I would just, if you're in a termination posture, I would highly suggest speaking with counsel, because there are a lot of intricacies to these requirements. The second escape valve is something called the unforeseen business circumstances exception. Under that, a layoff or a business closure occasioned by unforeseen business circumstances could trim the notice period. It does not eliminate the notice period. California governor has come out, said that this epidemic qualifies under the California unforeseen business circumstances exemption. New York has not done that yet. Maybe that's coming down the road. What that means is you don't have to provide the full 60 or 90 days notice. You just have to provide as much notice as is practicable. As a practical matter, that might be just a day or two, given your circumstances. But you provide that notice, you let them know that the layoff is occasioned by the pandemic, and you'll largely meet your notification requirements. So I'm going to end there and just briefly state that I recognize that this may raise more questions than answers. However, it's important to start thinking about these issues so that non-compliance is not a monkey on your back as we emerge from this crisis. Thanks.
Thank you. Absolutely. So thank you. We'll now move to business interruption. Given the growing effects of this COVID-19 pandemic, many organizations have unfortunately been forced to reduce business offerings or temporarily shut down of their operations. As a result, many organizations are turning to their commercial property policies to recover from business income reductions. In evaluating business interruption exposures under a property policy, I'll explain several crucial factors that may determine coverage from the specific carrier market. So if we begin as a door opener or requirement of coverage, most policies generally require physical damage to occur. So if we look at a standard situation, this would include a simple example of a roof collapsing and a business operation ceasing. However, unfortunately, with COVID-19 type losses, unique arguments will need to be formalized to create the physical damage component. We do expect that this first item will be a hotly debated and unfortunately disputed coverage element. In fact, we've seen coverage-related litigation already be commenced in this area. So this physical damage requirement typically also extends to business interruption, contingent business interruption, and civil authority. There are some other grants of coverage, such as under extra expenses, that may include the same physical damage requirement. They may provide, again, absent of physical damage requirements, for things such as evacuation, testing, or let's say a cleaning of a covered premises. In these situations, COVID-19 exposures within the facility will need to be documented. Unfortunately, in some cases, these grants of coverage typically have small sublimits and possibly even a time element trigger. So if we move outside of the physical damage requirement, the policy will also need to be examined to determine if a contamination exclusion exists. In many situations, these exclusions, unfortunately, specifically also include or are broadly written to include viruses. We expect carrier markets to, again, concentrate their coverage defenses in this area as well. So here at Lockton, we are in periodic updates and conversations with carrier markets, property claim heads, as well as overall global claim heads with our carrier markets. Thus far, we have not identified any broad positions on these matters. As you are likely aware, insurance carriers have the ultimate authority in determining coverage under a policy. Any potential losses may result from COVID-19 and should be reported to applicable policies in a timely manner. Now, keep in mind that some grants of coverage have short reporting guidelines, such as 24 or 48 hours. We will continue to monitor the situation, but these recommendations, we believe, will continue. So finally, regardless of the coverage applications, we do strongly recommend that organizations proactively document their incurred and ongoing damages. This information, we believe, will be crucial if coverage decisions are, let's say, overturned, or, as you've heard prior in this call, federal or state resolution is created specifically to help out on the business interruptions exposures. If you have any questions or have a unique situation, please reach out to a member of your Lockton team. Andy?
Thank you, Paul. At this time, we'd all like to thank you for joining us here today. We understand during these times it may be difficult to carve out an hour of your day away from your leadership roles within your companies. With the Boutique Lifestyle Leader Association, our goal was to reach out and provide assistance however and wherever we can for all of you. It's now more than ever that a community must come together and support one another. Lockton's coronavirus advisory practice is closely monitoring the developments of the pandemic on a global level, and we will continue to produce content to assist all businesses. As more applicable information becomes available, I'll make sure to share whatever we have with Ariella and Fran, and we can distribute it to the community as a whole. If anyone has any questions, please don't hesitate to reach out to Ariella, Fran, or myself, and we'll make sure to post the questions with answers to the Boutique Lifestyle Leader Association website. Speaking on behalf of the Lockton team and BLLA, we'd like to thank you, and we wish you all health and safety during this time.